Do higher rates, assuming we get them, because things can change, but assuming we get them, does that crush tech next year?
I wouldn't say so. If you look at big tech, there's about $300 billion of cash on their balance sheets. So there's certainly no issue with them in terms of being able to raise capital or put capital to work. What it does do is affect the DCF valuations that go into justifying the stocks where you need to look out to 2030 to generate the cash flows, which in turn justify the valuations. And a lot of those names are owned because people believe they are secular or structural winners in some sort of shift in the market. So what you'll see is a bit of separating the wheat from the chaff in some of those high multiple names, but it doesn't really affect the position of the big tech names very much.
So is it really then all about looking through and looking at companies that, to your point, Richard, have a lot of cash on the balance sheet? Because there's some names that don't. I mean, should we put an Adobe and an Akamai, which you just heard us talk about, JP Morgan, in the same basket as a Microsoft or an Apple?
Well, there was this huge discussion of Apple earlier in the week when they crossed briefly the $3 trillion Rubicon, which was completely irrelevant. It's just a number. There are other issues with Apple in which there's a huge buyer in the market of Apple every year called Apple. They're buying back $100 billion of their own stock because they generate so much cash, and they clearly can't put that to work in large-scale M&A. So as long as a company like Apple is continuing to recycle its own cash into its own equity, it puts a floor under the stock, or at least gives it some support, as well as the fact that institutional investors are somewhat underweight Apple. Now, you see the similar case with Oracle, but they're only generating about $6 billion of cash year to date, but they bought back $15 billion of stock, and one wonders how long that can keep going on. So I think you have to separate the companies that are generating cash and putting it to work, either in their own businesses or supporting their own stock, with the ones who would somehow be reliant on being able to raise further capital where the cost of capital is going up.
So you think Apple's a safe bet?
Well, I think when you look at the obviously, Brian, as you know, we can't talk about recommendations on programs like this, but when we have a buy rating on Apple, and when you look at a stock like that, you can see fairly predictable cash flows. And I think the surprising thing about Apple, when you look at over the long term, is how their business is more recurring revenue than many people assume, not just because of the services, but because of the propensity of people to stick with the brand. And you see that in names like Microsoft. Yep. You see that in names like Google. So they have better visibility looking out to 22 and many years beyond than people maybe have given them credit for. Well, let's face it, for most of the early part of this year, the likes of the big banks that you cited weren't talking about valuation. They were saying valuation doesn't matter, just chase the new secular winners.